Al, as we get into this next topic you mentioned earlier was it's retirement, and there we have a lot of listeners that have 401ks, IRAs, and they're being managed by somebody, either they're a company sponsor or somebody they don't really know. They think they're a nice guy or a nice gal, right? How many times a year do you hear from that nice guy or nice gal? It's usually once a year, if you're lucky. Now, there's a retirement crisis, and especially in the past 10 months or so, a lot of companies have slowed down their contributions to 401ks because of this whole pandemic. And a lot of people are not reaching their retirement goals because they're not getting the help. Partially is because the returns they're getting are not big enough. They're not tracking with what the market is doing. Partially also is because they're in mutual funds. So let's talk about some different techniques that the average investor may be able to partake or do within their company sponsor 401k, or even if they have an IRA with a broker or an advisor.
Yeah. Well, part of our goal, or one of our goals, I should say, is to keep our students from becoming a statistic as far as that retirement crisis is concerned. And there's a number of reasons that is the case, that there is a crisis. Uh, Not everybody has access to a 401k or to an employer-sponsored retirement plan, but you have access to an IRA. Not everybody knows what, to be honest with you, a lot of people have no idea what's in their 401k or why they're in what they're in. But when you ask how much advice they got and why they made those decisions, they're really not getting advice from anyone. The responsibility is almost 100% you, if you have a 401k or 403b, to make the decisions. Why are you investing in what you're investing in? Why would you stay in something if it's not performing as well as something else? I mean, you can trade within your 401k. So one of the things that we talk about in our classes is dynamic 401k management, how to get the greatest benefit out of it. The biggest benefit in my mind to 401ks is the free money. If you have a match, that's free money. You want to take advantage of that. But what's the advice that you get? You hear this all the time, and it comes from everybody out there. Put as much money as you can into your 401k, even after that point where it's matched. Well, what a lot of our students do is take that additional money, instead of putting it into an investment that has limited benefits and high fees, they'll set up a self-directed IRA where they don't have any fees. And why are fees so important? Well, we kind of hit on this every week, and I'm going to use this example again because I think it's really powerful. If you have $100,000 that you invest for 30 years at 7%, the end result should be $761,226 with zero fees. If you add 2%, that's $432,000 you end up with. You have lost or paid to the plan sponsor and loss of compounding. You've lost almost $330,000. How would you like to have an additional $330,000 today if you're in retirement? That could be yours. It could have been yours had you eliminated those fees. So in a self-directed account, you don't have the fees, and you're not just limited to mutual funds and maybe some individual stocks or ETFs. You can, in a self-directed account, you have the opportunity to trade the futures market, the foreign exchange market, the options market. So you can trade with that leverage. Not only does it allow you to have smaller amounts of money and control a bigger overall investment, but it allows you to participate in a down market. You can sell those assets. Options can be used as an insurance policy. So if the portfolio is going down, option strategies are there that will go up in value, that hedge that portfolio.
Let me ask you this. Why do you think, I mean, almost everybody just lets that happen? Why don't you think people take action in their retirement accounts?
Well, when you go to the airport to fly somewhere, do you sit in the passenger part of it, or do you get in the cockpit?
Yeah, well, I was in jail the last time I went in the cockpit. No, just kidding.
Hopefully, you're not getting in the cockpit because I'm not flying on that plane. It's because they have been conditioned to just accept the fact that there's these people out there, these smart people that are going to take control of your money and really benefit what you have. What you're not told is that those people are getting paid a lot of money basically for no advice other than saying, here's a selection of mutual funds that you can choose from. And the truth is also a lot of those companies are using a particular mutual fund family or families because they have what we call revenue sharing. They've basically been paid to choose those mutual funds. Again, they're charging large fees. And they also don't tell you that when the market goes down, your 401k, 403b is going to lose money because there's nothing in those plans that will benefit in a down market. Mutual fund managers can't short the market, they can't go to all cash. So you have maybe the possibility of somewhere between a 3 to 5% annual return with a potential loss of maybe 50 or 60% there hanging over your head. That's not a great risk reward. So, the 401ks do force people to save. That's a good thing. You get that free money. But there are other things that you can do. And there are other ways of making sure when you retire, because when you retire, you've worked maybe 30, 40 years, you have maybe another 20, 30 years, and your income is gone. What are you going to rely on? How are you going to access cash to pay your bills? How are you going to grow what you have so you have something to pass on down to your kids or your grandkids?
And think about that too. We were having a conversation not long ago with somebody, and they said, "Well, you're supposed to just buy and hold for the long term because the markets have cycles."
Sure.
And that's what my broker told me, right? That's what they're saying, right? So what you're saying is you're okay with losing money in down market cycles.
Yeah.
That doesn't make sense.
Yeah.
Why are you willing to do that? So you have to learn different techniques and skills. Remember the whole thing, do as I say, not as I do. The institutions, they're not buying and holding. They're doing these different techniques and strategies like we talked about in the second segment with futures and Forex and options. So Al, a lot of people just don't know where or how to start. You mentioned self-directing. It's basically just you're making your decisions in your own account, which is what you're doing with your 401k or IRA with a broker, but you're paying them to do that.
Right.
So there's ways to eliminate those fees, and it's self-directing, as Al was talking about. How does somebody get started doing that?
Right. Well, you hit it on the head. You're paying somebody for the opportunity to make your own decisions.
That was a tough one to say. It doesn't make sense.
It's tough. It's tough to say because it's so sad. So you're already your own pension fund manager, so to speak. You're already your own retirement advisor. But why not do it then in a way that gives you more opportunities to benefit? Is the market going to go down again? Will we ever have another correction or another bear market? Yeah, absolutely. That is part of the market. It is what has happened since this market has been created. It's going to continue to happen. So why would you want your accounts to go down in value with that buy and hold strategy, even though it's going to come back? So let's say that you had some money in the market in the year 2000. Well, in 2000, at that year, in the 2000, we went through a 50% drawdown on the S&P 500. So you lost 50% of what you had. Now you have to be up 100% just to get back there. Really, when that happened, when the market went up to get you back to where you were in 2000, that was 2008. Then what happened? Market went down another 57%. So anyone who was invested in the year 2000, if you go forward to 2014, 2015, now you're probably where you started in the year 2000. That was 15 years of lost time, and that's what we don't have a lot of, especially as we get into retirement. So protection is huge. That's the number one thing. But also, what rate of return do you need? And are you getting any kind of advice on that in your retirement accounts? And by rate of return, we're looking at what the return you need to get to achieve the lifestyle that is your goal in retirement. And this is kind of an extreme example, but just to show you why there's such a difference there, one person's goal might be to buy a yacht and sail around the world. Another person's goal might be to buy a kayak and paddle around Lake Harriet. Mm-hmm. They'll require different rates of return to be able to do that. So if you first have to identify where you are now, where you want to be, what do you want your retirement to look like, and then we can help identify the right strategies, the right assets to use to help you achieve that rate of return.
Which or means, have the potential.
Yeah, to have the potential to do that. There's no guarantees in anything in life, but you need to have the odds in your favor. You need to have an edge that will give you the opportunity or the potential to be successful.
Yeah, I'm glad you mentioned, what's happened in the past with these down markets. Well, Al, unfortunately, so many investors and traders right now have only experienced an up market, so they feel that up is totally normal. That's
Not only
okay.
that, a lot of the advisors that are out there now have only been in the business during an up market.
Correct. Yeah. So that's why it's so important to understand the strategies and techniques for this phenomenal up market that we're seeing, but also, as Al was talking about, learn those techniques and strategies to keep what you have. Because anybody can make money in the market. Not everybody can keep it. And that's the key, is how to protect what you have, especially in your retirement, because that's what you work, 20, 30, 40, 50 years for, is to get to those golden years of retirement. Coming up next, we're going to continue to talk about these great opportunities within retirement accounts and shorter term trading accounts with these up markets that we're seeing, and also how to protect them. This is Josh and Al with the Retire Young Radio